Hello, everybody. So thank you so much for joining us this evening. We'll just give it a couple more minutes for more people to join up before we kickstart this. But today's session is actually on how to optimize your cash savings for better returns and passive income. Right. So there'll be some introductions first. I think there's a new phase for everybody to see today. And basically, Grace will be going through some interest rates scenarios ahead of us. And then followed by Ritesh. Ritesh will go through some goals for your savings, and of course later on how to optimize returns and passive income. Right, so maybe we can just go through this slowly while waiting for the rest to join up. Right, so a little bit about Ritesh. Ritesh is the head of investment and advisory here in Syfe. I myself, I work under Ritesh. So Ritesh, he was previously from Goldman Sachs, assisting ultra high net worth individuals, family offices, and corporate clients. Before that, he was at Morgan Stanley, where he quickly rose to become VP of Market Risk. So he actually has 15 years experience in investment and financial services. And for Grace, the new face on the block, right? So Grace is our investment strategist. Previously, she was from UOB as an investment strategist and portfolio counselor. So she has more than 12 years of investment and financial services experience, and is, of course, a CFA charter holder, right? So maybe a little bit from Grace first. Oh, Grace, you're on mute.
Hi, everyone. Thanks so much for joining today's webinar. Yeah.
Thank you. Right, so a little bit about Syfe for the new joiners. We are a Singapore headquartered MES and SFC licensed digital investment platform. So Syfe believes investing should be accessible to everyone. We enable people through smart, affordable, and intuitive financial solutions, right? And this is essentially what we want and what we hope to achieve, right? To be the all-in-one destination to grow and manage wealth. And below, you can actually see the multiple awards that we have won. And as of yesterday, if you guys noticed, we actually won the top startups of 2023 again from LinkedIn. And a little bit about our platform is that we offer both wealth and trade. Wealth is whereby we offer managed portfolios. Trade is where you get to do some DIY investing in the US market and the Singapore market. Right, so trusted by over 100,000 investors in Singapore. We are a digital investment platform with a mission to empower people to build their wealth for the better future. So our innovative investment tools and strategies and access to the latest insights support users in acting for their financial future now. So this shows a little bit about the history of the company Syfe. So we started back in 2019, and through Series A funding in 2020, Series B 2021, we followed to launch Syfe Trade in 2022. And then, of course, Hong Kong in the May of 2022. That's when we quickly won the Wealth Management of the Year award in August 2022. And then we launched Syfe in Australia in the same month, and followed by one of our most highly regarded portfolios, the Income Plus portfolio, which is powered by PIMCO in April of this year. So safety of funds is definitely the most important. We are regulated by MAS under a capital market service license for conducting fund management activities and dealing in capital markets products, right? So your cash assets, right, typically held with a trust account, such as with DBS or HSBC. And for invested funds, right, they go through Syfe Wealth under Citibank and HSBC. And for Syfe Trade, individual accounts are protected up to $500,000. So a little bit of the poll questions. The polls working. Amanda, maybe you can run the poll from your end. Yes, some poll questions before we kickstart this. First question, right? Do you think the Fed will hike rates in November 2023? That's a simple one. We'll give it maybe 1 minute. Right, let's move into the results, Amanda, if everybody has answered. Right, so most of you believe that the Fed will implement one more rate hike, but only about 21% mentioned that Feds will remain unchanged. What do you think of this, Grace?
Yeah, interesting. Since most of our audience are on the so-called hawkish side, we may have a little bit different opinion, but I will come back to this in a short while.
Okay. And is this results expected, Ritesh, for yourself?
I think so, because I think people are guided by the latest Fed speak. So when they gave the guidance, they did indicate that there will be another rate hike coming in November. Having said that, as Grace mentioned, I don't think the market anticipates that yet.
Gotcha. Right. So without further ado, I'll pass it on to Grace.
Yeah, sure. So thanks, Marvin. So I think for many of you, you may have already read in the news. So just let me have a very quick recap about FOMC meeting last week. So last week, basically the Fed chose to keep interest rates unchanged, but they indicated that there could be a potential rate hike in November. So following this meeting, we have seen some sell-off over the last few days. So basically for this chart is a Fed stop plot. So it looks a little bit busy, so just allow me to explain. So just a quick side note for those who are not very familiar with the Fed stop plot. So for Fed, it's not just one person. So behind all this interest rate decision, there is a whole community. So just like any other group of people, there are different opinions, different thoughts. So each of these thoughts is actually a forecast from one of those community members. So basically the Fed stop plot actually gave us a little bit more insights into the different opinions, different discussions behind the closed doors. So the blue dots are for the forecast in June. Then the purple ones are as more for the forecast for the recent September. So basically there are two things I would like to highlight. So first one is in the short term. So basically I think you probably are reading in the news, the media quote, stay higher for longer. So basically any rate cut could come a little bit later than we hope for, and the pace could be a little bit slower. So back in June, if you still remember, right, there was a banking crisis. So everyone was more concerned about potential recession. So back in the June meeting, then Fed expect we could see 4 rate cuts in total form. But fast forward to September, I mean, in third quarter, we say U.S. economy is has been quite resilient. So now basically they're thinking about just 2 cuts next year. So I mean, this is definitely not something the market want to hear. So this led to some short-term volatility in the market. But secondly, what I want to highlight is really about longer term. That means what's the direction for the policy rates in the next 2 years. So if I can draw your attention to the table, so basically I summarize the average forecast for the Fed officials for the forecast going forward. So if you look about their forecast, so basically in 2024, they expect that the interest rate to go lower to 5.1%. So roll into 2024, 2025, basically they're thinking about 3.9. So even right now, yes, I think in the short term, there could be a hike, may not be a hike. But what's important, I think, to highlight is really like, if you look about 2 years, that's basically still, I mean, most of the officials still expecting the interest rates to go lower. So, I mean, this forecast could change depending on, market conditions. But for now, looking at all these projections, it seems like we can expect the rates to trend lower from current level for the next 2 years or even 3 years. Next slide, please. So this question related to our poll question. So I mean, despite what seems like a very hawkish guidance from the Fed, so this chart basically shows the probability of a rate hike in November based on rate futures. So what's interesting to note is that even after the Fed's big meeting last week, basically the market is still leaning towards a 77% chance that there is no hike in November. So there is only about 23% are expecting hike. So what does this tell us? This is suggest that most traders are not convinced that the Fed will go through another hike in November. So it feels more like that the Fed, it's more, they want to put a strong posturing. They want to show people that they are very tough about inflation, but they may not necessarily go ahead to really hike the rates. So I think the thinking behind why the traders think that way. I think next slide, please. I think the main reason behind all the traders, why they think they think the chance for the Fed hike in November is not very high, is because inflation rates are coming down. So this is not only about US. This is about the last one. Yeah, thank you. So it's really about the inflation globally are coming down in all the major economies. So the red line is for US inflation rate. Blue line is for Europe. Then the yellow one is for China. So if you compare to last year, the headline inflation rate in the US almost halved. So the inflation in other major economies are also coming down. So I think given such a market condition, maybe there is less pressure for the Fed to really go ahead with another hike. So next slide, please. So I think many of you may be thinking like, why do we, only talk about US rates? How about, the rates in Singapore? And just to give you a little bit backdrop. So I think for Singapore, basically MS manage the monetary policy a little bit different from other central banks. So for other central banks, they manage rates, right? But for Singapore, MS really focus on foreign exchange. So because as a result of this, basically our rates here in Singapore are very much influenced by the US rates. So basically, if you take a look about this graph, basically this graph plots about 3-month SORA rate. Basically, SORA rate is when mortgage rates are pegged to against the US Fed fund rate. So if you look about the chart, basically you can see both rates are moving in tandem. So when the Fed fund rates go higher, then SORA tends to go higher. Then if the Fed fund rate start to declining, then SORA tend to fall as well. So if you link back to our discussion earlier, if we are thinking about in next 2 years, we are expecting a good chance that the Fed may start cutting rates. I think for our rates in Singapore, we may start to see lower rates as well in Singapore. So I think that really wrap up our views about interest outlook. So yeah, back to you, Melvin.
Great, thank you so much, Grace. So maybe we'll run one more poll question here first. Right, so what is the current return or yield on your cash savings? Now, this is an interesting question because I think most of us have been hearing about how rates have went up, but we just want to see how many of us is truly enjoying the advertised rates so far. So again, we'll give it about 1 minute before Amanda can cue the results. What's the interest that you're enjoying on your account, Ritesh?
Not very great, I would say. Yeah, I have a savings account with DBS, and I think currently it hovers around the 1.8% mark.
I think it's super difficult to get the higher tier interest rates, right?
Yeah, exactly.
And Amanda, maybe you can run the results now. Right, so as you can see, right, most people enjoy between 2.1 to 4% per annum. Wow, 5% do enjoy above 4% per annum. 4% actually not sure, right? 25% is less than 2%.
Yeah, no, I was just like reading this and not entirely shocking, right? But definitely something that all of us can improve upon, because what I see here is like 90% of the people are actually below 4%. I mean, there is obviously a greater percentage in that 2 to 4, but there is also like 25%, which is less than 2%. And, that kind of tells me that people are not really fully enjoying the high interest rate environment that is prevalent at this juncture. And definitely there is room to improve.
Okay, maybe I'll pass it on to you from here. Let's see what we get from you.
Absolutely. All right, great. So I think we'll move on to the next section, which will really focus on number one, kind of setting goals for your different cash savings, as well as being cognizant of, putting too much cash in just savings accounts means that you're actually losing money over the long term, because we talked about inflation, we talked about the different interest rate paradigms that are unfolding in front of us. And the reality is that when it comes to traditional savings oriented instruments that we typically deploy our money into, we don't really maximize our yield on that cash. I think overall, if you look at the markets have evolved, and that gives us a lot of opportunities and different instruments to kind of make our cash work harder for us. So in today's session, we will cover a lot more about, what are the different forms of cash needs that you have over the immediate needs, things that maybe you need in near term, and then future needs as well, right? So we categorize it into these, buckets, which is called as now cash, soon cash, and later cash. And what that essentially encapsulates is your needs of cash in terms of time horizon. And the now cash basically caters to, cash needs that you have on a more immediate basis. So typically less than 3 months. Examples of it will be your day-to-day living expenses, emergency funds. This is money that you need on a very immediate basis. You don't want any uncertainty about that money. You want very high liquidity, and you want as low as possible on terms of the risk element within this cash, right? So this is where, typically people will use savings bank accounts for these kind of, these kind of money needs. So this is your now cash. Also, people do have near-term money needs. So this is what we call as soon cash. So the typical money needs stretches from, say, 3 months all the way till 2 years. And these could be, in terms of examples, savings for special occasions. You want to save for your wedding, you have a family trip coming, you have a high-ticket item that you want to purchase. Again, I think in this as well, you need a relatively strong sense of certainty in terms of returns, but you can sacrifice a little bit of liquidity, because when it comes to the need of this cash, you don't need it immediately. So you can afford to keep the money kind of locked in for a longer period of time to essentially, I believe, increase the returns, right? So your risk appetite changes and increases a little bit, but at the same time, it is still, the certainty aspect that you still care for. The liquidity aspect you can kind of compromise on a little bit, depending on the length of the goal that you are trying to solve for. And then as we move on to the later cash, this is money that you don't really need, and it is available on a free flow basis. So there is an opportunity for you to optimize this cash for better yield. You might not necessarily want to invest this cash for long-term, retirement goals or other investment goals. So you still want to keep it relatively liquid, but at the same time, you want to optimize the yield that you generate on this particular cash, because, you can afford to keep it for a longer duration of 2 years or above. Typical examples of this could be savings for upgrading your HDB to a condo. You want to do cash flow matching. So this could be interesting. You have a mortgage payment on one side, and you want to generate enough interest to cover for that mortgage, right? So that could be an interesting way to think about later cash. As well as if you just want to generate regular income, you want to cater to some of the day-to-day expenses from the regular income that you generate from, this pot of money. You are not so much concerned about the liquidity aspect. You do care about having it liquid and all, but you also are able to afford keeping it for a longer duration, right? So you are able to take some market fluctuations for this pot of cash with the view that because you're holding it for longer, it will also give you, higher returns, but because you're taking higher risk. So if you move on, why is it important to have this kind of setup? It's important because we talked about it earlier. Inflation is pretty high. A pot or a plate of chicken rice that was available, say, at $3 in 2014 costs you $0.16 right now. In terms of dollar absolute number, it might not seem big, but when it comes to the actual increase, it's a 32% increase, and even in a longer duration standpoint, that is around 3% per annum. So you're looking at a longer term inflation trend of 2 to 3%. If you look at the current inflation trends, it's more like 4%, right? So of course the inflation trends are coming down, but the fact is, if you have money just sitting idle, then you're losing money, right? And whatever you can buy from that money right now, you will not be able to afford it 1 year down the line or 2 years down the line. So it's very important to optimize your cash savings and think of your cash savings in a more goal-oriented manner as well. So now I think in the next section, what we'll discuss is a little bit more about the different tools that are available for each of these buckets. So when it comes to the now cash, obviously most of us keep our now cash in a high yielding savings bank account, right? We want to make sure that our money is super safe. Banks do, provide that kind of, I would say, comfort for us, because typically banks are too big to fail, right? And we are here covering like some of the major banks, major local banks in Singapore. Their base rate is obviously very, very low, right? If you just invest, just put the money in their cash savings account, you will not earn much interest, and the base interest rate is 0.05%. Of course, if you can meet certain conditions and you invest into some of their high yielding cash savings accounts, then you can get higher returns. As I was discussing earlier, my own DBS multiplier gives me 1.8%, and it kind of caps out. But there are, the OCBC and UOB where you can get even higher. But again, for you to get these, higher rates, you need to satisfy a bunch of criteria, right? You need to credit your salary. You need to have minimum spendings on your credit card. You need to invest with them. You need to buy insurance from them. So in reality, it is very hard to hit these high numbers when it comes to generating these interest rates from your high yielding savings bank account. Of course, you will still keep money in your savings accounts because the money is immediately available. You want to buy something, you have your bank credit card or debit card available, you tap and you're good to go. So that aspect of, having that immediate liquidity is very important. And we do want to keep a good chunk of our money still in a savings bank account. There is an added insurance layer that also helps us when it comes to, if the bank were to fail, then you're still protected with SDIC. But again, when it comes to optimizing your savings, then you need to think a little bit deeper. Do you want to keep all your, key emergency funds as well as your daily expenses in only a bank account? Because you do encounter then a tiered interest rate system, you have a maximum cap, and you have to kind of, match to a lot of these conditions. And that's where potentially you can consider a solution like a Syfe Cash Plus Flexi. Now, this particular portfolio that we have on our platform is also very, very liquid. It invests into what are called as money market funds. And money market funds typically are underneath investing into very high quality interest-bearing instruments, which are typically again, they can invest into fixed deposits, they can invest into treasury bills, they can invest into high-quality corporate, but typically they will invest in a very short-term basis, and they will give this, in a format then which makes sure that, Melvin, there is something, yes, all right, thank you. If you can go back, please, yes, thanks. So when it comes to, you as an investor, these instruments and these funds are fully liquid. So they provide T+1 liquidity. And when it comes to our solution, we bring together the best money market funds such that we can optimize your overall yield. So this particular solution gives you 3.7% as a projected rate of return. And the good thing is there is no minimum requirement, there is no maximum cap, there is no tiered system. The returns actually accrue on a daily basis. And we, on our hand, as well, optimize by using the institutional share class of the underlying money market funds, which typically as a retail investor, you do not have access to. So yes, I mean, like there are certain aspects that you need to consider when it comes to the returns. They're not guaranteed, but the fact that they are essentially liquid and investing into a diverse portfolio of very high quality instruments, actually it is, in my opinion, not a bad choice, or in fact a very good choice when it comes to deploying cash with pretty high liquidity and also keeping track with inflation. Because typically what happens is as the interest rates increase due to the interest rate increments from the central banks, the money market funds, the rates will also keep on increasing. And that's what a lot of our clients have been able to seamlessly generate, versus the bank accounts, they typically take a lot longer to increase their interest rates over time. So you get a faster tracking of increasing interest rates in the market when you're investing with a Syfe, cash plus flexi versus, your typical savings accounts and all. So in terms of key highlights of this product, just kind of highlighting them on the next slide. You get a projected return of 3.7%. There is daily accrual of returns. There is no max or minimums. No lock-ins of your investments. You get, next day withdrawals. So if you, withdraw your money by say 11 a.m. on a given day, you will get the money back, the next business day. And also, I think for people who want to optimize their monies for not just cash investing and cash savings, but also for longer term investing, then they can look to put that money and invest into recurring, buys across our investment portfolios as well. Now, coming on to the soon cash section, this is where essentially your goals are more, slightly longer term. So you want to save for, some high ticket items or some other cash needs and goals, which stretch between say 3 months to 2 years. Now, typically there are, again, a traditional set of instruments that are available for you to invest into. And a lot of us do invest into that, right? Like, fixed deposits have been there for a fairly long period of time. Now, of course, in terms of yields, they are a little bit lower. So they stretch depending on which bank you're putting the fixed deposit. It stretches between 2.7 to 3.5%. And then in Singapore, more specifically, you have additional instruments such as Singapore savings bonds and the treasury bills. These are, government oriented, products or government designed products that allow you to save for the longer term. SSBs are basically savings instruments that the, Singapore government and MAS has come up with, which allows you to save over the longer term. So you can invest for, about, a 10-year period and all. With T-bills, they are shorter term instruments. So you can invest for 6 to 12 month kind of time horizons. And the interest rates for the T-bills actually move closer to, what the interest rates are in the broader market and all. So you will see a slightly better tracking with T-bills when it comes to investing for, these soon goals. In terms of like some of the key differences between these products, of course, like, when it comes to fixed deposits, these interest rates typically are now much higher for the shorter duration between 3 to 6 months. The SSBs, the typical tenure is 10 year. So you can invest for the full tenure. They're obviously redeemable anytime, but typically your interest rate increases over time, right? So for you to get higher interest in SSBs, you need to keep, it invested for the longer duration. Again, I think there is, pros and cons when it comes to investing in SSBs. At the current juncture, the interest rate of SSBs typically a bit lower compared to fixed deposits and T-bills. Plus, once you lock in that interest rate, then you cannot change it, right? So if the interest rate continues to move up, you will again be locked into that 3.2%. But if the interest rates are higher, then you cannot capture those higher interest rates. Yes, you can redeem, but there is that added hassle that you need to redeem it first, then redeploy it into something else. T-bills on the other side, like you can invest for 6 to 12 months, so relatively shorter on the time horizon. But again, you need to keep those investments as is. There is no early redemption. You can obviously sell T-bills in the secondary market, but that then subjects you to the actual prices of these T-bills in the secondary market. And T-bills are issued at discount to their face value. So if you want to get the 3.7%, you will typically buy the T-bill at a discount, so say $98 or $97, and then at maturity, you can get that $100 back, right? So that's how the T-bill kind of mechanism works. You cannot redeem it early, but you can sell it in the secondary market, but then you're subjected to the liquidity of the secondary market, which is, as per what I have observed, not super liquid. And also, the day-to-day, fluctuations in prices because it's the secondary market and all. Of course, the capital itself is kind of guaranteed. So, and that is actually true across, all these different instruments. In fact, like our cash plus guaranteed is also, guaranteed in terms of return and capital. I think this is a slight, mistake in this chart. What we need to highlight is there is no insurance kind of protection, right? Like, when it comes to, the fixed deposits, SSBs, T-bills and all, there is an aspect of, insurance. We don't have insurance, but in terms of capital guarantee, our cash plus guaranteed is also capital guaranteed. So just like switching on to what the cash plus guaranteed brings to your table, this is something that we have just launched over the, in fact, like just last 1 month, and we have seen a tremendous response from our user base in terms of adopting this particular portfolio, because in the current environment, people love having certainty in terms of return. And in terms of the rates that we are able to get, it's actually pretty competitive compared to a lot of these other options that are available in the market. The term and duration of this guaranteed solution is also much lower at 3 months. So it doesn't lock you for a very long period of time, and which kind of gives you, much early liquidity, and you can keep redeploying that into, this particular solution. So there is an option for you to reinvest back after 3 months into the guaranteed solution. You can withdraw after the end of the term. And again, because it's only 3 months, it's not too hard for you to keep that money locked in for that short duration of time. And the good news is, like, there is no minimum, there is no maximum, there is no transaction costs. Typically SSBs and T-bills, there will be some transaction costs whenever you want to withdraw and redeem and stuff like that and all. And it's a hassle-free way for you to invest into, invest your cash savings for relatively short durations and get a guaranteed return. So when it comes to the key highlights of our cash plus guaranteed solution, if you go on to the next slide, essentially you're getting a guaranteed return of 3.7%. Now, how are we generating this 3.7%? We are basically putting the money into fixed deposits. So it's a portfolio of fixed deposit that we currently are using certain Singapore banks. So currently it is HSBC. And I think, again, one of the key points that I want to highlight on this front is the fact that when we as Syfe, as an institution, goes to a bank, we are able to negotiate much, much better and higher interest rates for our fixed deposits compared to individual clients who might not have enough capital to deploy, so they're not able to negotiate very high interest rates. So that's one of the key reasons when you go to the fixed deposits that are available individually at the bank, it ranges between 2.5 to 3.5%, approximately 2.7 to 3.5, I think, versus our guaranteed solution gives you that extra kicker of, at least 20 to 30 basis points. If you compare some of the, lower tier banks, it can be as much as 1% extra kicker that you get from our guaranteed solution. And this will continue because, again, as I said, we optimize the rates by partnering with a lot of different banks, and we will basically give you the best optimized rates. As an institution, we are able to negotiate these with these different banks and all. On your side, then you are not subject to any minimum, you are not subject to any maximum, there is no fee, and you have the flexibility to reinvest after every 3 months. Now, I think moving on to the next section, and I'm conscious that I'm running over time, so I'll cover some of these, or I'll try to cover these in a faster manner. But essentially, when it comes to later cash, typical instruments that you would want to use for later cash will be bonds and potentially REITs, right? These are, some of the instruments where you are able to generate relatively higher yield compared to your traditional savings instruments that we talked about, which were, say, SSBs, T-bills, fixed deposits, and your high-yielding savings accounts. If you want to elevate your yield, then you need to invest into bonds, and you need to, go into corporate bonds. You need to go into higher-yielding bonds. You need to go into, different parts of the world to kind of, get that higher yield and all. Now, typically, it is very hard for people to invest into individual bonds because each bond, you need a minimum of $200,000. So a lot of investors would invest into either a bond fund or a bond ETF. Now, when it comes to these kind of instruments, each of the bond funds, they typically give you exposure to very specific, fixed income sectors. So what that means is what yield you generate really depends on which bond fund you're investing into. And for you as an investor, you really want to target a certain amount of yield, and you want to keep your risk relatively, stable. And that's the reason where a Syfe Income Plus kind of portfolio can come into play, where we focus on you as a client, and we try to optimize a portfolio of, fixed income instruments such that we are able to generate you certain amount of yield, and you are able to generate it on a very consistent basis and all as well. And we then manage, what the different exposures to different fixed income sectors and all would look like. versus like when you invest into individual unit trusts, then a lot of these other aspects come into play as well. The dividend taxes, especially for ETFs, is particularly important, because if you're investing into a bond ETF domiciled in US, then you're subjected to 20 to 30% withholding taxes. Versus in our case, when we are investing into the underlying bond funds through our Income Plus portfolio, we optimize these tax implications because we invest into the Irish domiciled underlying bonds. There are no currency costs. So I mean, typically, again, depending on which bond fund or ETF you're using, if they're USD or foreign currency denominated, you'll be subjected to FX costs and all as well. Versus in our case, we have a hedged kind of share class of underlying fixed income bond funds that we are using, which ensure that your currency implications and FX risks are minimized. And then last but not the least, the most important thing is obviously the fees. Typically, bond funds, the cost of investing, and especially retail bond funds, is very high, approximately at least 1.5%. Similarly, bond ETFs, while the costs are lower, but then there are these inefficiencies that you need to overcome when it comes to tax implications, FX risks, and others and all. Versus Syfe Income Plus then is kind of a portfolio which we have curated for you, and we have combined the best kind of instruments to optimize for returns, for yield, and then minimizing your tax implications, your FX risks, and the cost of investing as well, because the funds that we use the Insti share class funds of our partner, which is PIMCO, and because of that, the cost of investing reduces quite substantially. So again, highlighting the two portfolios that we have on the Income Plus. If you go on to the next slide, Melvin, there are two portfolios. One mainly focusing on investment grade bonds. So those are basically very high quality in nature, and investing into US Treasuries and corporate bonds. And the objective of that is for you to generate very stable income with capital preservation. Then there is an enhanced portfolio where you are focused to generate a little bit higher income and you want some sort of capital appreciation. And that is achieved by taking some credit exposures, by taking exposure to certain high yielding bonds, such as high yield and emerging markets as well. So in terms of yields, the yields are pretty high, between 6.7% and 8.2%. And then these bond funds also pay you out on a monthly basis in terms of dividend yield. So those dividend yields range between 4% to 6%. If you move on to the next section, I think we'll skip this one and we'll go on to the next one. The other instrument that you can typically use for later cash is REITs. And REITs for Singaporean investors is a very popular product because the structure of REITs is such that they need to give you 90% of their income needs to be given in the form of dividends to shareholders. So if you invest into REITs, then you are able to generate very consistent flow of dividends over time. Now, again, individual REITs you can buy, but then you need to decide which REIT to buy, and it is not very easy. We've seen a lot of examples recently where certain individual REITs have tanked quite massively. So it is important to diversify. Now, in terms of diversifying your REIT exposure, you can obviously do it through instruments such as REIT ETFs, which are now available in good numbers. But also there is our Syfe REIT Plus portfolio, and this is where again the optimization of how you deploy your money into REITs can be done in a more efficient way. So while in REIT ETFs, you typically need to open a brokerage account. Your dividends are not automatically reinvested. In our case, we automatically reinvest. There is no minimums that you need to invest on our platform. Our management fees are much lower compared to the management fees that are typically there for REITs. There is no brokerage or transaction fees on our platform. In our case, we track the portfolio very closely to the benchmarks that we have. In fact, our portfolio has outperformed the benchmark on a very consistent basis because we do certain optimizations on top of tracking the underlying index that we have. And the dividend payouts are done on a quarterly basis. So if you want to generate an income on a regular basis, then you can opt for payouts of your REIT dividends on a quarterly basis back to your bank account. All right, so if you go on to the next slide, it just kind of talks to you about the two options that we have on our platform. So the 100% REIT portfolio tracks the IHS REIT Leaders Index developed in partnership with SGX. It invests into 20 of the largest REITs in Singapore. the dividend yield is 5.8%. And over a longer term, you can expect this particular portfolio to not just generate you income, but also some capital growth. So that's why you see the overall total return of the 100% REIT portfolio at 7%. Versus there is also a risk managed version, which will give you a little lower return over the longer term, but it's a little bit more safer compared to the 100% REIT portfolio in terms of the drawdowns and fluctuations that you will observe. All right, moving on. I think it's just a highlight of how REITs have been a very resilient income generator. So over time, you can see that they have consistently given very good payouts, even during COVID, right? They did not drop below 4%. You go on to the next slide, and that kind of brings us to our complete suite of cash and income solutions. When it comes to the Syfe platform, now you have instruments available where essentially whether you have cash goals which are more near term in nature or immediate in nature, your soon cash kind of needs which are say 3 to 2 year in time horizon, or you have later cash needs, you have a full range of products available for you to optimize those from both, a yield standpoint, as well as, from safety, liquidity, and payout standpoints and all as well. So obviously the risk kind of goes higher as you move from the flexi, which gives you 3.7%, and you move to the extreme right on the REIT side, the dividend yields are much higher, the overall total return expectations are much, much higher and all as well. But then you progressively take more risk because you can afford to as your money needs and cash needs are longer as well. We will do a quick case study. I think it will make it a little bit more clearer. I think this is the more interesting part for us. So this is Benson, and he's 35-year-old, married with one kid. He has a 4-bedroom HDB, and he currently earns a gross salary of 10K Singapore dollar per month. His household expenses is approximately 5K per month. He also has a mortgage on his HDB. So typically he will be paying around 2.5K per month. Now he tries to maximize the CPF monies to pay for his mortgage. So he utilizes 1.8K out of his CPF to pay for his mortgage. And the remaining 700 comes in the form of, cash. Also, he's got 200K in savings, right? Now, in terms of how he manages these savings at this juncture, he's putting, kind of spread across very safe instruments, right? So he's putting bulk of his money in a DBS multiplier account, generating 1.8% there. But then he's putting some money into SSBs and fixed deposits, and he's, able to get a slightly higher yield of 3.2%. But at the same time, he's not fully optimized because he's got an idle cash of 50,000 where he generates the base yield of 0.05%. And that basically means on a overall basis, he's generating some yield, but overall, if you look at the total, it is 2.1%. And that is not too far off from the poll that we did, right? Most of the people were between 2 to 4%. And then there were around a quarter of percentage people who were actually below 2% as well. So I would say approximately 50% of people, bare minimum, will be around this range in terms of the yields that they have in their current cash savings. Now, when it comes to, how does that map out in terms of annual cash flow right now for him? Because he's generating this 120K of yearly income. And because of, the savings and all that he's doing, he's able to earn this $4,000 of interest income. So his total income maps out to around 124K. Now, in terms of the expenses, he's got 5K. We mapped out that it was a 5K per month expenses. So that's $60,000. And then he's partly paying his mortgage through CPF, but then there is a mortgage of 8.4K that gets paid out from his cash. And that in a way is expense right now for him because his interest income is not able to fully cover that cash outflow, which means that his net savings actually $34,000. And there is a potential for him to do better, right? Because as we shared earlier, his yield is 2.1% right now. Now, in terms of what can he do better, one of the possible ways he could redeploy some of his monies is by thinking again in a goal-oriented manner. What are his current cash needs? What are his near-term cash needs? And what are his later cash needs? So when it comes to current cash needs, yes, he can still keep a good amount of his money in savings account, but he doesn't need to keep, 50 plus 50, 100K, right? Like, he can put the amount for which he can maximize the yield there. So potentially if he wants to remain with DBS, then 1.8% there. But then he can split some of the money into an instrument such as cash plus flexi, because then he can elevate his yield to almost double or more than double at 3.7%, right? So he's able to generate much more, yield on the now cash without sacrificing on the liquidity, right? Because liquidity is very important, safety is very important. And because it is money market oriented products, those things are still catered to. When it comes to Soon Cash, right now he has no plan or no strategy to save for Soon Cash, but he has a house renovation coming in 12 months, and that will need $20,000. Now, in this, he can afford to lock in part of his money. And Syfe Cash Plus Guaranteed can be one instrument through which he can do that, because 3.7%, you keep, renewing your Cash Plus Guaranteed every 3 months, and you're looking at 3.7%. So that is another way for you to, optimize on the Soon Cash needs. And then later cash needs is, we focus on cash flow matching on the mortgage side. So he's actually gotten this mortgage for which the outflow is around 8.4K is what we discovered. And he's not fully covering that mortgage payment. So he can potentially redeploy a lot of his funds into, our income portfolios and REIT portfolios, where the yields are much, much higher at 5.5 to 6%. And there, if you look at just this 4,600 and 3,400, that actually covers pretty much all his mortgage. And on a total basis, he's able to increase his yield to 5%. So now if you go back and see where his original, actually go to the next slide, where I think it will map it out very clearly, how the cash flows look like for him before the optimization versus after optimization, right? And this is, again, an illustrative example. You don't necessarily need to follow it. But what I think this tries to demonstrate is the fact that now you're generating $9,900, close to $10,000 of annual interest, and you're fully able to cover your mortgage payments. And at the same time, you are generating an extra 5,000 in net savings, which, by the way, if you go on to the next slide, then can be deployed into long-term investments, because this is savings and you already are catering for your emergency funds, your all near-term cash needs. So you can really invest that for the long term to retire comfortably as well. Because if you invest that $39,000 or $40,000 and you keep investing regularly over 20 years at an 8% rate of return, you're able to get to $2 million, right? Again, this is illustrative, but the point is really about optimizing your cash and making each of your dollar work harder for you. I think I'll take a break at this juncture, and maybe we can focus on a few questions.
Okay, thank you so much, Ritesh. So maybe first question from an attendee, right? So presently, he has capital growth, stockpile, and the property purse, and they're all losing money. So would you recommend switching to the income plus portfolio?
Sorry, Melvin, just repeat that one more time.
Right. So this attendee presently has about three different portfolios: a core growth portfolio, a equity 100 portfolio, and a REIT portfolio, and they're all losing money. So would you recommend switching to the income portfolio?
Right. See, look, I think when it comes to, goals, there are, in this particular session, we have covered goals which are more cash oriented. So this is not necessarily money that you really want to invest into the market for long-term growth. When it comes to this particular client, I'm not, entirely sure what his exact goals are. But if my assumption is that his investments into core growth and equity 100 are more for long-term investing and growth, then I don't think he should change that into anything else, because they are really catering for his, say, retirement or a goal that is 10-year, 20-year down the line. And the fact is that while the equity markets have obviously been choppy over the last 1.5 years, primarily because of the fact that interest rates have been going north at a very, very fast pace. And that has really impacted the equity market in a pretty massive manner, because last year we saw the equity markets down 15 to 20%. And growth equities down by more than 30%. And this year, while the equity markets have started to recover a bit, but there is still a lot of uncertainty. But if you have a horizon of 10, 20 year going forward, equities will still be the instrument of choice when it comes to beating inflation and generating extra returns for growth over the long term. So I don't think he should necessarily change his strategy when it comes to long-term growth needs. But when it comes to income needs, if that is one of his other goals that he wants to optimize for, then he can possibly diversify his REIT investments into, bond investments and all as well. So the income plus could be a great instrument for him to deploy. And again, if he's not sure about the markets at the current juncture and he's got cash available with him, then potentially in terms of places to put the money, our income plus solution is pretty, I think, attractive play at the current juncture, because when it comes to how the interest rate environment looks like, you are able to generate close to high single-digit returns between 5 to 8% from fixed income instruments, which essentially is equity-like returns, right? If you go back 2 years, 3 years, you're not able to generate more than 3-4% returns in fixed income. Now, with even investment grade and very high quality bond investing, you can easily generate 5.5%, 6%, even 7% returns. So when it comes to risk reward, obviously fixed income looks very, very attractive from that standpoint. But when it comes to goals mapping, then you need to really think about what are the exact goals that you're trying to map for and optimize for each goal, rather than trying to switch your equity to bond just because the bonds look attractive now, because you don't know when the equities can rally.
Thank you so much, Ritesh. So maybe another one. This one is quite interesting. For the income portfolio, do you think it's more suitable for like a one-time investment, like with a lump sum, or do you think like a regular investing works better for it?
Yes, I think it really depends on, again, which stage of life you are and what you're really trying to solve for. Typically, I would say bonds are safer compared to equity-oriented investments. And I would think of our portfolios to be designed in a way where they are catering to specific investment objectives. So yes, if you are looking to generate a certain amount of income, you need to put a certain lump sum, right? So for example, if you want to generate $1,000 a month as passive income, you do need to put approximately 200,000 plus into the income plus solution, because again, 200,000 multiplied by 5% or 6%, then it comes close enough to that $1,000 a month kind of mark, right? So if you want to target a certain amount of income, then yes, you should be able to deploy in chunks. And compared to equity markets that can have wild fluctuations and all, usually our income solutions, which will be much more stable. So I do recommend, if you're really targeting income, then you can deploy money in bigger chunks. But at the same time, if you are a young investor and you don't necessarily have that $200,000, $300,000 to invest at one go, you can slowly have an income target and then grow accordingly, right? So you can start with, say, a 20,000 or 50,000 initial amount, and have a target that over the next 5 years, I will reinvest the dividends that are coming from my bond portfolio. But in, say, the next 3 years, 4 years, I'll make it big enough such that they, then it is able to give me that $500 or $1,000 a month as regular income, and then I will be able to take it out at that point and switch.
Right. All right. Thank you so much, Ritesh. Maybe one question for Grace, right? I think this is the question on a lot of people's mind. My REIT Plus portfolio has been a REIT since I started investing back in 2021. Should I consider holding on, or should I consider selling out?
Yeah, I think yes. I think many REIT investors may have this question. I think for last 2 years, basically, it has been quite tough for REIT investors because of the rising interest rates. So to answer this question, I think you can think through 3 points. So first one is, are you comfortable holding the underlying REITs? Do you think you are holding the REITs with good quality of assets? So if you are comfortable holding them, I think basically that's the first question you have to ask yourself, right? If you talk about REITs Plus, basically for us, I think we invest only the top 20 REITs in Singapore, and most of the allocation is focused on the bigger and more established REITs. So I think the second question basically we have to ask ourselves is really about where do you think the interest rate would turn in next few years, right? I think for us, based on our views, in the next 2 years, maybe not so soon. That means basically the interest rate may not come that soon. That means not in the 6 months. We think maybe in the second half next year. So maybe so basically I think for REITs investors, you need to be a little bit patient. So the turnaround may come, but may not be that soon. I think the last question is really about, as an individual investor, what's your risk tolerance? I think for REITs, still, the volatility is lower than equities, but still higher on bonds. So because it's a little bit tilt to the volatile side, then you have to ask yourself whether you are comfortable. There could be periods of loss. I think maybe I will because I don't know what's the case for different investors, but for myself, I would think from this tree perspective, then decide. Yeah.
Great, thank you. So maybe one more question, right? With current interest rates being attractive, should I park more of my cash towards SSBs and T-bills, or do you think, like the cash plus guaranteed still makes a lot more sense?
Yeah, I think, look, obviously these instruments are in the market and are available in a very easy manner for a lot of investors to put money to work. I think the main difference between investing into these versus the cash plus guaranteed is the fact that we make it super easy for you, right? With each of these instruments, there is a specific way for you to subscribe, to redeem, and you need to keep track of, how the interest rates are changing and moving and all. And there are repercussions if you do want to redeem some of these instruments earlier, right? So for fixed deposits, there are penalties. With T-bills, again, you're subjected to secondary market liquidity. With SSBs, yes, they're redeemable anytime. But then, again, if you want to redeem, if you say redeem today, then you will actually get the redemption in the next month, not immediately. And plus, the rates are actually a bit lower when it comes to SSBs compared to the T-bills and FDs and all. In our case, this is all that we then focus on in terms of optimizing for you, right? We actually negotiate, as I shared earlier, with all the banks and give you the best rate. So you don't need to hunt for the highest yield switching banks, right? You don't need to create 5 different bank accounts just because you're trying to optimize your fixed deposit. You just have to come to one place and we will find the best kind of return in terms of, the guaranteed aspect of our cash plus solution. So I think that is a key point that you can note when it comes to allocation. Obviously, there is a natural tendency for us to have that safety aspect, which kind of SSBs and T-bills, the government backing and all helps. But even the cash plus guaranteed gives you guaranteed returns, right? And the reason is because we are actually putting your money into a fixed deposit with a Singaporean bank. So the only reason why you will not get that return is if an HSBC or a DBS or one of these banks go under, which is if that happens, then we have even much, much bigger problems generally. So I think this is in a way great for Singaporean investors. This is, in my opinion, a little bit groundbreaking and innovative because now you don't need to hunt for the highest yields. We bring the highest yields for you.
Thank you so much, Ritesh. So maybe let me look into one question, right? So this attendee asks, should I focus on earning through dividends from STI ETF or the REIT portfolio, or rather capital growth type of ETFs like VOO or VUG? What do you think? Dividend investing or capital growth investing?
Look, I think, again, it maps back to goals. I would say as a growth investor myself, I actually have a much higher allocation to, equity-based investments because I'm investing for the next 20 years, right? So if it is a more long-term goal where you are trying to solve for retirement or child's education, so, those kind of goals, we covered that as the last part because I think, again, this part of our webinar was very much focused on income and cash savings, right? Like, how do you optimize for that? Now, of course, in the current paradigm of where interest rates and all are, I think dividend stocks could be a decent play, but then, I mean, you're also subjected to the fluctuations of the stock market. I mean, this is something that Grace previously, told about the REITs market as well. When it comes to more of these kind of instruments, which have a lot more capital fluctuation, you need to just make sure that you're sufficiently diversified. So yes, you can deploy into some equity dividend oriented stocks. You can invest into REIT Plus or the REIT ETFs. You can invest into bond funds or the income plus portfolio from us. You can kind of spread across these different interest bearing instruments, but that is really for your income needs. If you want to get capital appreciation for the long term, then I would still invest with a VOO or CSPX or other instruments or our core equity 100. These are portfolios that are optimized for long-term growth for you.
Right. Thank you so much, Ritesh. I think that's all the time that we have for today. Any closing statements, actually?
All good. I think it was a pleasure speaking about all different cash options for investors at the current juncture. I think we are at a very important point with respect to the markets. There is still a lot of uncertainties, but it also presents us with a lot of opportunities to optimize our cash savings. So definitely do reach out to us if you have more questions. We have a full-fledged advisory team, Melvin included, and essentially we'll be happy to answer more one-on-one if you have a specific question on yourself.
Right. Thank you, everybody. Do have a great evening ahead. Take care.
Thank you.